Chapter 1. The Genesis. The birth of Bitcoin, the enigmatic Satoshi Nakamoto, the intricacies of blockchain and mining, and the reasoning underpinning Bitcoin's design and the halving process, the foundational building blocks of our journey, the inception of Bitcoin. The story of Bitcoin began in 2008 when an unknown entity using the pseudonym Satoshi Nakamoto published what is known as the Bitcoin white paper titled Bitcoin, a peer-to-peer electronic cash system. This groundbreaking document laid the groundwork for a decentralized currency that relied on a technology now known as blockchain. The concept was revolutionary, promising a world where financial transactions could be carried out peer-to-peer without a central authority or intermediaries, such as banks or governments. The mysterious figure of Satoshi Nakamoto. Satoshi Nakamoto is perhaps one of the most intriguing figures in the world of technology. Despite countless efforts to uncover Nakamoto's identity, it remains a mystery. Yet this anonymous entity has profoundly impacted the financial world by introducing Bitcoin. Nakamoto's vision was to create a decentralized currency that could not be controlled by any government or institution, a currency that would provide financial sovereignty to its users. Understanding the blockchain and mining blockchain, the technology underpinning Bitcoin, is a type of distributed ledger. It's essentially a chain of blocks, where each block contains a list of transactions. Each block is linked to the previous one via a cryptographic hash, ensuring the integrity of the entire chain. If someone tries to alter a transaction in a block, it will change the hash of that block and every subsequent block, which the network would notice. Mining is the how new Bitcoins are introduced into the system, and transactions are confirmed. Miners use powerful computers to solve complex mathematical equations, the solution of which leads to the creation of a new block in the blockchain. The miner who solves the problem first gets rewarded with newly minted Bitcoins and transaction fees. The rationale behind Bitcoin's design and the halving process. The design of Bitcoin has engineered with a key principle in mind: scarcity. Unlike traditional fiat currencies which can be created from nothing at will, leading to inflation, Bitcoin has a maximum limit of 21 million coins that can ever exist. This was Nakamoto's answer to the problem of value erosion seen in traditional currencies. The halving process is a fundamental part of this scarcity design. Every 210,000 blocks, approximately every 4 years, the reward for mining a new block is cut in half. This event, known as halving, reduces the rate at which new Bitcoins are created, thus controlling inflation and mimicking the process of mining a finite resource, much like gold. The genesis of Bitcoin and its accompanying technologies marked the genesis of a new era in finance, challenging traditional notions and paving the way for a financial revolution that continues to unfold. As we delve deeper into this world, we'll explore how these initial design choices have shaped Bitcoin's journey and the wider crypto economy. Chapter 2. The Halving Events. As we explore Bitcoin's halving events, we will delve into the heart of each occurrence, 2012, 2016, and 2020, examining their impact, the market's reaction, and some telling anecdotes that have defined each of these milestones. The first halving event, 2012. The first Bitcoin halving event occurred on November 28, 2012, when the block reward dropped from 50 to 25 Bitcoins. As a relatively new concept back then, it was uncharted territory for everyone involved. The anticipation was high, and speculation was rife about how the market would react. Contrary to some predictions, the immediate impact on Bitcoin's price was subtle. The price had already begun to increase in the months leading up to the halving, but it didn't explode right after the halving. However, in the following year, Bitcoin experienced its first significant bull run, with the price surging from around $12 to over $1,000. One popular story from this time was of a miner who, having forgotten about his old Bitcoin stash, discovered he was suddenly a millionaire thanks to the price surge following the halving. The second halving event, 2016. The second halving event occurred on July 9, 2016, with the block reward reducing from 25 to 12.5 Bitcoins. By this time, Bitcoin had gained considerable attention, and the global financial community closely watched the event. The market reaction was again relatively muted immediately after the halving, with the price remaining stable for several months. However, 2017 saw Bitcoin reach its all-time high of nearly $20,000, a monumental surge many attribute to the preceding halving. During this period, a popular Bitcoin meme was born, CHODL. It originated from a typo in a forum post by a user who declared he was holding during the volatile market, and it quickly became a mantra within the community, signifying the strategy of holding on to Bitcoin irrespective of market fluctuations. The third halving event, 2020. The third halving occurred on May 11, 2020, amidst a global pandemic, reducing the block reward from 12.5 to 6.25 Bitcoins. This event was different. It was the first halving in the era of COVID-19 and widespread economic uncertainty. The immediate market reaction was once again subtle, but the following months told a different story. In December 2020, Bitcoin smashed previous records, reaching a new all-time high of approximately $28,000. By early 2021, it had surged to over $60,000. Anecdote: the 2020 halving sparked a wave of mainstream interest in Bitcoin. Notably, the business intelligence company MicroStrategy, led by CEO Michael Saylor, began investing heavily in Bitcoin post-halving, heralding a new era of institutional adoption. Each halving event marks a significant milestone in Bitcoin's history, providing valuable insights into market dynamics and the evolving narrative surrounding this groundbreaking digital asset. These events have shaped Bitcoin's journey, and their effects continue to ripple through the cryptocurrency world. As we look towards the future, the past halving events offer clues as to how the next may unfold. Chapter 3. The Miners. In the Bitcoin ecosystem, miners play an integral role. This chapter delves into their world, their profiles, the impacts of halving on their operations, and the evolution of mining technology and pooling practices. Profile of Bitcoin miners and their role in the ecosystem. Bitcoin miners are diverse, ranging from individual hobbyists operating from their home computers to large-scale mining farms with vast arrays of specialized hardware. Regardless of their scale, all miners share a common purpose: to secure the Bitcoin network and validate transactions. Miners do this by solving complex mathematical puzzles, a process that requires considerable computational power. Successfully solving these puzzles results in the creation of a new block of transactions on the Bitcoin blockchain. Miners receive newly minted Bitcoins and transaction fees as a reward for their efforts. The effect of halving on miners, interviews, and case studies. The Bitcoin halving has a significant impact on miners. Each halving event reduces the reward for mining a new block by half. This means that miners' revenue is effectively cut in half overnight. Interviews with miners reveal mixed feelings towards halving events. On the one hand, the reduced rewards increase the pressure on miners, particularly those operating with thin profit margins. On the other hand, these events often drive up the price of Bitcoin, potentially increasing the value of the rewards miners do receive. Case study. A prominent example is the Chinese mining farm operator Mr. Wu, who navigated the 2016 halving by strategically investing in more efficient mining equipment. Although his immediate block rewards halved, the subsequent price increase meant his long-term revenues significantly increased. The evolution of mining technology and the role of mining pools. Bitcoin mining has evolved dramatically since Bitcoin's inception. Mining could be done on a regular home computer in the early days. Today, the process requires specialized hardware known as ASICs, application-specific integrated circuits, which are designed specifically for mining Bitcoin. As the difficulty of mining has increased, miners have also begun to pool their resources, forming mining pools. These pools allow miners to combine their computational power to mine blocks more consistently. While the rewards are shared, the increased regularity of finding blocks can lead to more stable incomes for miners. In summary, Bitcoin miners play a crucial role in maintaining and securing the Bitcoin network. Despite the challenges brought about by halving events, the mining community has shown resilience and adaptability, continuing to drive the Bitcoin network forward. As we look toward the future, the evolution of mining technology and practices will undoubtedly continue to shape the landscape of Bitcoin mining. Chapter 4. The Market. This chapter delves into Bitcoin's market dynamics, including halving events' impact on Bitcoin's price, market sentiment, and volatility. We'll also examine prediction models like the stock-to-flow, S2F, and discuss the influence of speculative trading and institutional investment on Bitcoin's market. The impact of halving on Bitcoin's price, market sentiment, and volatility. Historically, halving events have significantly impacted Bitcoin's price, albeit not immediately. Following each halving, the price of Bitcoin has tended to rise significantly, often reaching new all-time highs. This is likely due to the reduced supply of new Bitcoins entering the market, creating upward pressure on the price. Market sentiment often becomes bullish leading up to and following a halving event. This optimism is typically driven by the expectation of price increases, as has been the pattern following previous halvings. However, these events also increase market volatility. The uncertainty leading up to each halving, combined with speculation following the event, often results in significant price swings. Analysis of prediction models like the stock-to-flow, S2F. Model. Several models attempt to predict Bitcoin's price, one of the most prominent being the stock-to-flow, S2F model. This model is based on the ratio of Bitcoin's existing supply, stock, to the production rate of new Bitcoins, flow. According to the S2F model, halving the production rate leads to a decrease in the flow of new Bitcoins, increasing the S2F ratio and suggesting a rise in Bitcoin's price. While the S2F model has been successful in predicting Bitcoin's price trends historically, it's important to note that it's based on the assumption that scarcity drives value. Critics argue that this model doesn't consider other factors that can influence Bitcoin's price, such as demand fluctuations and regulatory changes. The role of speculative trading and institutional investment in Bitcoin's market. Speculative trading plays a substantial role in Bitcoin's market. Traders looking to profit from short-term price fluctuations can cause sudden price movements, contributing to Bitcoin's volatility. Institutional investment, on the other hand, has typically been associated with longer-term price stability. As large organizations and traditional investors have started to invest in Bitcoin, their typically longer investment horizons and larger capital reserves can help stabilize the market. In recent years, the entry of major institutions into the Bitcoin market has signaled a growing adoption of Bitcoin as a legitimate asset class. This has provided additional liquidity and contributed to the maturation and increased credibility of the cryptocurrency market. In conclusion, the dynamics of the Bitcoin market are complex and multifaceted. Halving events, speculative trading, and institutional investment all play crucial roles in shaping Bitcoin's price and the broader market sentiment. Understanding these factors and their interplay becomes paramount as we continue to explore the world of Bitcoin. Chapter 5. The Wider Impact. We turn our gaze now to the broader consequences of Bitcoin's halving events. We'll consider their influence on other cryptocurrencies, their role in Bitcoin's environmental impact debates, and how these events relate to Bitcoin's ideological vision of deflationary economics. The influence of Bitcoin's halving on other cryptocurrencies. Bitcoin's halving events have ripple effects throughout the entire cryptocurrency ecosystem. As the first and largest cryptocurrency, movements in Bitcoin's price and market dynamics often influence other cryptocurrencies, a phenomenon known as Bitcoin dominance. Around the time of a Bitcoin halving, some investors may venture into altcoins, alternative cryptocurrencies, seeking higher returns, which can stimulate those markets. Conversely, the anticipation of a Bitcoin price surge following a halving can draw investment away from altcoins. Some cryptocurrencies, like Litecoin, have halving events built into their design, directly mirroring Bitcoin's model. These coins experience similar market dynamics around their own halving events. Halving and its role in discussions around Bitcoin's environmental impact. Bitcoin mining consumes an extremely large amount of energy, which has led to debates about its environmental impact. Some argue that the halving events, by reducing the reward for mining, could indirectly reduce the energy consumption of the Bitcoin network. However, this viewpoint is contested. Critics point out that if the price of Bitcoin rises following a halving, as it has historically, this can incentivize even more mining and potentially increase overall energy consumption. The halving event in relation to Bitcoin's ideological vision of deflationary economics. Bitcoin's design, including the halving events, embodies an ideological vision of deflationary economics. Unlike inflationary currencies, where the supply increases over time, Bitcoin's supply is capped at 21 million coins. The halving events ensure that the creation of new Bitcoins slows down over time, introducing scarcity. This deflationary nature challenges the conventional monetary system, where central banks control the money supply. Bitcoin presents a system where monetary policy is predefined and cannot be altered by any central authority. The halving events serve as a stark reminder of this principle, as they occur regardless of external economic conditions. In conclusion, Bitcoin's halving events have far-reaching implications beyond its own ecosystem. They influence the wider cryptocurrency market, contribute to environmental discussions, and reinforce Bitcoin's stance on deflationary economics. As we continue to delve into the world of Bitcoin, these wider impacts underscore the extensive influence of this groundbreaking technology. Chapter 6. The Future. The future of Bitcoin presents an intriguing landscape, filled with speculation, potential, and a fair share of uncertainty. This chapter presents a thoughtful exploration of what lies ahead for Bitcoin. We'll consider the forthcoming 2024 halving event and its potential implications, deliberate the scenario when all Bitcoins have been mined, and contemplate the broader influence of Bitcoin on our financial systems and societal structures. The road to the 2024 halving. The clock is ticking down to the fourth Bitcoin halving event, expected to occur in 2024. In the cryptocurrency world, the anticipation is palpable. Market participants, from everyday investors to cryptocurrency experts, are watching this event, which could potentially redefine Bitcoin's market landscape. Predictions about the post-halving scenario are as diverse as the Bitcoin community itself. Many analysts, drawing from the price surges that followed past halving events, anticipate a significant increase in Bitcoin's value. But as always, it's important to bear in mind the inherent uncertainty of such predictions. Cryptocurrency markets are notorious for their wild price swings, and any number of factors could disrupt even the most well-considered forecasts. As we edge closer to the 2024 halving, these predictions will continue to evolve, shaped by a range of variables, including macroeconomic factors, regulatory developments, and shifts in market sentiment. These dynamics add a layer of complexity and intrigue to the already captivating narrative of Bitcoin's journey. Beyond the final Bitcoin, a glimpse into the far future. One of the most thought-provoking questions about Bitcoin's future is what happens when mining all 21 million Bitcoins is complete. Considering that Bitcoin's design relies on mining to create new coins and process transactions, the cessation of mining rewards presents a fundamental challenge. The most likely scenario is that transaction fees will become the primary incentive for miners. However, this raises questions about the affordability and efficiency of Bitcoin transactions. If fees rise too high, could that deter users and undermine Bitcoin's utility as a medium of exchange? On the other hand, could technological advancements or changes in usage patterns ensure that Bitcoin remains viable even without new coins entering the system? This transition represents uncharted territory, not just for Bitcoin but for the world of cryptocurrencies as a whole. The implications of this shift will be astonishing, and it's potentially reshaping the economic model of Bitcoin and other similar cryptocurrencies. Bitcoin's Echo: Reflections on Financial Systems and Future Implications. Beyond the specific details of halving events and mining, Bitcoin's journey has broader implications. By challenging traditional financial systems and introducing a decentralized, deflationary currency model, Bitcoin has already made a significant impact. Looking forward, it's clear that Bitcoin, and the broader cryptocurrency movement it has sparked, will continue to play a significant role in the future of our financial systems. As it evolves, it could potentially drive changes in everything from banking to contract law to the very concept of money itself. Whether or not Bitcoin itself endures, the ideas it represents, decentralization, transparency, and deflationary economics, are likely to continue influencing our society. As we contemplate the future, these underlying principles, perhaps even more than the specifics of halving events or mining, may leave the most enduring legacy. In conclusion, the future of Bitcoin is as captivating as its past. While the path forward is uncertain and fraught with complexity, it's clear that the journey of this groundbreaking technology is far from over. As we watch the unfolding story of Bitcoin, we are not merely spectators of a technological evolution, but active participants in a momentous period of financial and societal transformation.